Going over IRS Form W-4R, which is the withholding certificate for non-periodic payments and eligible rollover distributions. So we covered this tax form about a year ago towards the end of 2023, and since then it's become one of our more popular videos. So what I wanted to do in this one is kind of go over the form itself, which has been updated for the 2025 tax season. Go over some of the points that you can read in more depth in our accompanying article, and then go over some of the questions that a lot of people had over the past year and just cover them in this video. So really quickly, this is the tax form that you would use for like one-time distributions or non-recurring payments. So if you wanted to take a lump sum out of your 401k, or if you had what's considered an eligible rollover distribution, you would use IRS Form W-4R. There may be other times where you would use form like W-4P for periodic payments from your pension plan or your retirement account. So make sure that you are certain as to which type of withholding certificate that you need to use. And then also, if you're using this for a custodian like an IRA or a 401k, you can also check with your custodian to see if there are other settings that you can use within your account that basically replicate the instructions in this W-4R. So you may very well just be able to go through your portal, select the payment or the tax withholding percentage directly, and then it will generate the same information as your Form W-4R. So let's go ahead and go over the form. You see it's pretty straightforward. I mean, it is one half of a tax page, and then the rest of it is basic instructions. So at the very top, our hero John Doe puts in his first name, middle initial, last name, social security number in line 1B, and then the address. If you've recently relocated, you'll want to make sure that you keep your address up to date. You can do that by updating your tax return or filing your most recent tax return with the new address. You can also file the change of address form. That would be IRS Form 8822 or IRS Form 8822-B for business owners. That wouldn't necessarily apply to this, but some people may need to do both. So we'll put links in the show notes to both of those articles so you can kind of tell the difference for yourself. Line 2, you're going to determine the withholding percentage, and then you'll sign and date it and give it to the payer. So if you don't put anything in here, then your default withholding rate is either 10% for non-periodic payments or 20% for default withholding on an eligible rollover distribution. So really quickly, one of the more common questions was what an eligible rollover distribution is and how you can avoid the tax withholding. So let's imagine that you've changed employers and you're going to take your 401k and you're going to roll it over to your new 401k, and that your new plan allows you to do that. So your old 401k provider would send you a check, and that check will have a default withholding of 20% taken out of it. So on a $100,000 balance, you would see that it's missing $20,000. You would have a check for $80,000. Under the 60-day rollover rules, you have 60 days to take that $80,000 check and make sure that it gets to your new custodian. But not only that, you also have to make up the $20,000 to avoid taxation on any amount of that distribution. If you don't take that $20,000, you're going to end up paying taxes on that amount, even though it was withheld for taxes. It's kind of unfair. It's not. it seems like it comes out at the end when you file your tax return, but the problem is for a lot of people that are under the early withdrawal penalty age of 59 and a half, any amount that's taxed is also subject to a 10% penalty. So you end up either having to come up with that 20% difference out of cash from your own bank account, or you're going to pay taxes on it. So I've always encouraged people to arrange for a direct transfer between custodians. So you would contact your 401k administrator and ask them to walk you through that. But basically what that means is a direct transfer or a direct rollover involves the custodians from one account to the next account, and you don't actually get a check. And if you do it that way, then you don't have to have the default withholding rate. So again, two different tax-free ways to transfer money between retirement accounts. One of them involves you having to come up with the default withholding difference, that 20%, to avoid taxes. You'll get that back on your tax return because it is taxes withheld, but you know, if you're having to pay $20,000 on your $100,000 401k transfer, then that's $20,000 that's coming out of your bank account, or you're going to end up paying the taxes and the early withdrawal penalty. So let's imagine that John Doe is taking out a lump sum from his IRA, and he's of age. He's not going to pay any early withdrawal penalties. For a non-periodic payment, you can choose anywhere between 0% and 100%. If you leave it blank or if you don't have one on file, the default rate is 10%. So one of the more common questions is, why can't I use my marginal tax rate? Well, for Form W-4R, you can. And the way you would do that is you simply go to the marginal tax rate table, and then you figure out, first your filing status. So let's say that John Doe is married filing jointly, and he believes that his total income for 2025 is going to be about $200,000, which puts him squarely in the 22% tax bracket. So you would end up putting 22% in here. And it's that simple. One of the more common questions is, why isn't it not that simple on other forms like W-4P, W-4? I don't have the answer to that. I don't work for the IRS, so I can't really tell you why. I just know that that the IRS has made that available for this form, but it really hasn't done that for any of the other ones that I am aware of. So just keep in mind that a couple things. One, this is only for non-periodic payments. If you have like monthly amounts coming from your IRA or an annuity, then you probably should be using IRS Form W-4P instead of IRS Form W-4R. The IRS does put out publications that have updated guidance. It's pretty arcane. It's not very user friendly, but it's information for custodians and for accounting departments to have on file, to give them very specific instructions on how to withhold taxes. So let's just double check. There are a couple of other questions I do want to cover. So if you bear with me, let me get to them in the comments of my other ones. So if a person is, here's a common question. If a person's retired and they're the beneficiary of a non-qualified annuity, they take this lump sum while selecting 0% withholding, are they required to make estimated tax payments, or can they wait until they receive the Form 1099-R? So basically, a non-qualified annuity, if they took the lump sum out of it early in the year, there's a different situation than if you took it out towards the end of the year. And the reason why is because the IRS generally expects that you pay taxes on your income as you accrue it. So if you had $50,000 of income in December at the very end of the year, then the IRS would most likely consider that appropriate that you pay the taxes on that by the tax filing deadline. But if you took that same $50,000 and that was taxable income in January, then you're not allowed to get away with just waiting through the entire rest of the year all the way until the next year's tax filing deadline to pay taxes on that amount. So be careful about the timing of your withdrawal when you're making this calculation and when you're deciding to put in your marginal tax rate. Because you can you don't have to use your marginal tax rate. You can select zero withholding. So the IRS doesn't necessarily care how you withhold taxes. They just care that they receive tax payments. And this is one way to do tax payments as you earn your income. So there are other questions, but most likely most of them end up talking about how to use the marginal tax rate. So, if you don't know what your marginal tax rate is, generally speaking, the best way to do that would be to go to your prior year tax return, and then you can use that as an estimate for this year. I mean, the tax rate tables do change. They're adjusted upward for inflation over time. But from year to year, there's not a significant, not too much of a difference. So if your income is relatively stable and you don't have any one-time taxable events, then you should be able to take a look from last year and say, hey, I was in the $100,000. I made $100,000 last year. Looks like I'm if I'm married filing jointly, looks like I'm probably somewhere in the 12% tax bracket, right? So anywhere between 0 and 30,000, you're at 0%. Anywhere between 30 and 53,850, you're at 10%, so on and so forth, right? So if you're at $100,000 last year, you're probably at $100,000 this year as well. So if you had significant tax events, you would need to account for them either in the current year or back that out of the last year's tax year. If you stopped making payments to your 401k, if you started making contributions to your IRA, if your children aged out of certain, the child tax credit, or those are all tax consequences where you may need to adjust your withholding to make sure that the right amount of tax is being paid. So we do cover this as well as other frequently asked questions in our article. So you can check that out if you go to teachmepersonalfinance.com and type in IRS form W-4R. You'll see articles that we've done on just about all of our W-4 forms. So you can check those articles out. You can check out, if you just search for W-4R, that one article will pop up. You can also watch the other videos to see if they're more applicable. But if you like our articles, please check out or please subscribe to our newsletter. It should be easy to do. If you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions, comments, or if there's another topic that you'd like to see covered in an upcoming video, please hit me up in the comments section. Thank you very much and have a great day.